Getting paid a dividend every 3 months is nice, getting paid every month is even better, and getting paid every week sounds amazing. But that's also the problem because it's really good marketing. We have to remember that ETFs are for-profit products. They make money for fund managers by charging expense ratios. That's not necessarily a bad thing, but we do want to make sure that we're buying ETFs that are actually worth the money. So on the surface, it seems like SoFi is trying to target the market of dividend investors wanting more frequent payouts. When I heard about their weekly paying dividend ETFs, WKLY and TGIF, my red flags immediately went up. Are these just low quality ETFs designed to make money off of what people want, or are they actually worth investing in? And if they are, does compounding your dividends every 3 months, every month, or even every week make a difference? Let's find out. Remember, I'm not a financial advisor and this is not financial advice. Check out the disclaimer on your screen now. The ETF WKLY is also known as the SoFi Weekly Dividend ETF, and it seeks to provide investors with consistent income by tracking the SoFi Sustainable Dividend Index. The ETF is composed of 439 holdings, and the top holdings are Bank of America, Broadcom, Chevron, ExxonMobil, Johnson & Johnson, JP Morgan Chase, Merck & Co., Nestle, Pfizer, and Procter & Gamble. This ETF has an average yearly return since inception of minus 0.91%. And if you invested $10,000 at inception and reinvested your dividends, your investment would now be worth $9,829.24. WKLY has a dividend yield of 3.36% and an expense ratio of 0.49%. Investors can expect a weekly dividend of 2 cents per share based on the past 2 years of dividend payouts. Our next ETF is TGIF. It's also known as the SoFi Weekly Income ETF, and it seeks to provide weekly income by investing in investment-grade and high-yield fixed income securities. The ETF is composed of 175 holdings, and the top holdings are bond positions with Ford, Credit Suisse, AirCap Holdings, Owl Rock, NMI Holdings, Barclays, Depository Trust and Cleaning Corp, NatWest Group, US Bank Corp, and One Main Financial. This ETF has an average yearly return since inception of 1.45%, and if you invested $10,000 at inception and reinvested your dividends, your investment would now be worth $10,365.05. TGIF has a dividend yield of 4.63% and an expense ratio of 0.59%. Investors can expect a weekly dividend of 5 to 7 cents per share based on the past 2 years of dividend payouts. So we've established that these ETFs are legitimate investments, but there are some questions. Like, how are they able to pay out a weekly dividend if all of their holdings don't pay out weekly dividends? Now, we don't have a clear answer, but my guess is that they have a pool of money that they can draw from, which is then replenished when the holdings actually pay out. Now, the second question that we should ask ourselves is this yield accurate? My thoughts are not exactly. I haven't been able to find a reason why these ETFs pay out huge dividends the last week of the year, or why it hasn't been happening every year. Now, I know the funds haven't been around for a long time, but that does raise some concerns. The dividend yield is listed as higher than I would like because of these larger payouts at the end of the year. To calculate the dividend yield percentage per share, we take the annual dividends per share, divide this by the current share price, and multiply by 100. Without the large December payment, the dividend yield falls. It doesn't seem to be guaranteed, so if you're trying to buy the stock right before the end of the year and get a huge dividend payout, you might want to rethink your strategy. And if you're buying these ETFs based on the dividend yield, that's something to be aware of. In my opinion, one of the biggest risks for these ETFs is the fact that they're new. There's not a lot of history to go on. And in addition, it's hard to justify investing in them because there are other ETFs that offer higher yields that are less risky. But those risks might be worth it for some investors that are still considering getting weekly dividends. So let's see if the compounding effects of weekly dividends really make a difference and if it's worth justifying the risk. Using this very simple compound interest calculator, we can see the effects of compounding interest head to head. In our example, we took a $10,000 initial investment with a 5% yearly return and invested it for 10 years. We then set the calculator up to compound weekly, monthly, and yearly. After 10 years, we see that compounding weekly, we ended up with $16,483.25. Compounding monthly, we get $16,470.09, and compounding yearly, we get $16,288.95. Clearly, there are benefits to compounding more frequently, but in my opinion, this effect isn't enough to justify buying an ETF based on the weekly dividend payout alone. The key takeaway for every investor is that the quality of the assets and the strategy of the ETF matters a lot more than the dividend payout frequency. Income investors might want to consider these ETFs just given the frequency of the payouts, and they have been pretty consistent, but that's a risk that each investor has to take on their own. I do see these two ETFs as being a really good investment for some individuals who want that frequency of dividend payouts to help keep them motivated and to see more frequent dividends coming in addition to help keep investing into the markets over the good times and the bad. So I wouldn't say WKLY and TGIF are bad ETFs or bad investments overall. There might just be better options for most investors out there. So don't be misled by a weekly dividend. If you found value in the video, click that like button, subscribe for more money, finance, crypto content. I'll see you in the next video. Take care.